Buongiorno. Thank you, Francesco. It's such a pleasure to be here today, and I will talk about the policy challenges that are facing Europe. And I think Christian is, of course, perfectly right. It's a very difficult time to be a central banker, and this is what I'm going to talk about. Russia's invasion of Ukraine is a turning point in the global geopolitical order, and it brings unspeakable human suffering to the people of Ukraine. But it is also having a marked impact on the euro area economy. As we all know, inflationary pressures are rising further, reflecting our dependency on fossil energy and on Russian raw materials. Aggregate demand, in turn, is suffering from the higher energy prices and from considerable uncertainty. Fiscal and monetary policy can shield society from such large shocks. The pandemic was, of course, a showcase for how fiscal and monetary policy can jointly protect employment and price stability. Our forceful monetary policy measures, including the bond purchases and access to cheap funding for banks, were successful in delivering highly favorable financing conditions. And by preventing fragmentation, monetary policy allowed fiscal policy to protect jobs and incomes at a time when financial markets were vulnerable to destabilizing price spirals. Thanks to the joint policy response, the euro area was on track to experience one of the fastest recovery in history before the invasion. So my first slide shows that from trough to peak, euro area real GDP expanded by 17.5% by the end of last year, compared with 14.8% in the United States. The war will, of course, slow the pace of the recovery, and it will lift inflation further away from our target and for a longer period. A shock that moves inflation and output in opposite directions poses a challenging trade-off for monetary policy. If it reacts to higher inflation, it risks exacerbating the decline in demand. But if it does not react, it risks that high inflation becomes persistent. Central banks have typically managed this trade-off by looking at the likely persistence of the shock. If the shock to inflation is expected to be temporary, monetary policy can in principle look through higher inflation. If, however, the shock is expected to be more persistent and affect inflation over the medium term, monetary policy needs to act. So the question is, how is the war affecting the medium-term outlook, and what does this imply for fiscal and monetary policy? Part of the current elevated inflation can still be expected to vanish over time even without monetary policy action. Supply bottlenecks will ease at some point, and the extraordinary rate at which energy prices are currently rising can be expected to slow. However, a considerable part of inflation is likely to prove more persistent for three main reasons that I would like to talk about. So the first relates to pipeline pressures. The left-hand chart of this slide shows that producer prices in the euro area increased by more than 30% year-on-year in January, which is a level never even remotely seen in the past and significantly higher than in the United States. The right-hand chart shows that transitory supply shocks can only explain part of this rise, according to a recent IMF study. It shows that strong aggregate demand, so these are the blue bars in the chart, has been as much a driver of recent pipeline pressures in the euro area as supply bottlenecks. The war means that pipeline pressures are likely to strengthen further, even if demand slows. As prices adjust only slowly, the aggregate effect on final consumer prices will be felt over a long period of time. The second factor relates to structural forces, such as the green transition and globalization. There's broad consensus that before the pandemic, supply-side factors were putting persistent downward pressure on inflation across many advanced economies, including the euro area. Today, these factors are likely to reverse. Take globalization as an example. In response to Russia's aggression, European governments are seeking to limit their dependency on global value chains in areas of strategic importance, thereby accelerating the reshoring efforts that had already begun after the outbreak of the pandemic. Deglobalization may thus undo or weaken a trend that we had seen before the pandemic. Faced with risks of offshoring, unions had prioritized job security over higher pay. The war can be expected to loosen this brake on wages and hence inflation. The energy transition will add to upward price pressures over the medium term. While our economies will benefit from lower electricity prices once energy demand can increasingly be met with renewable energies, substitutes for Russian energy inputs will very likely be more expensive over the short to medium term. The third factor relates to wages. The left-hand chart of this slide shows that in February, the euro area unemployment rate fell to yet another record low of 6.8%. So this is the blue line. Here in Italy, unemployment in February was at the lowest level in more than 10 years when ignoring the statistical effects of the pandemic. The right-hand chart shows that the ratio of unemployed workers to job openings, which is a measure of labor tightness, hit a new record low at the end of last year. Survey data collected after Russia's invasion of Ukraine suggest that businesses continue creating jobs at a fast pace. A tight labor market at such an early stage of the recovery is generally a good predictor of strong future wage growth. And even if the war may weigh, and it probably will, on labor market dynamics, workers are likely to ask for compensation for the loss in real income when inflation has been high for a long period of time. There are two reasons why this catch-up in wages has not yet happened in the euro area. One is that job retention schemes kept a lid on labor market churn. Relative to the size of the shock, the unemployment rate in the euro area barely budged. By contrast, unemployment in the United States, so this is the yellow line in the left-hand chart, rose sharply. And when the economy reopened there, the creation of new job opportunities allowed workers to bargain for higher wages. The second reason is that in the euro area, total hours worked have still not fully recovered to pre-crisis levels, to a large extent reflecting the supply constraints and remaining contact restrictions. Those working reduced hours are unlikely to bargain for higher wages. It is therefore not surprising that we have so far escaped the fast wage pressure observed in other parts of the world. Instead, we are likely to see a delayed, staggered, and possibly longer-lasting response to wages. Together, these three factors, pipeline pressures, structural change, and wage catch-up, imply persistent upward pressure on inflation, even as the recovery slows. We are conscious of the fact that measured inflation, albeit at historical highs, is still understating the true loss in purchasing power. The left-hand chart of this slide shows that while owner-occupied housing, the light blue bars, is an important contributor to inflation in the US, it is not yet fully reflected in the official price index in the euro area. The right-hand chart shows that if one were to include these effects, core inflation in the third quarter of last year would have been 0.6 percentage points higher. The question then is whether the impact of the war on real incomes is sufficiently strong and long-lasting to offset these upside pressures on inflation. The baseline scenario of our most recent ECB staff projections, which you can see on the left-hand side, and which includes only a first assessment of the impact of the war, still foresees output this year to expand by 3.7%, which is still well above potential. More recent private sector forecasts expect the economy to slow more markedly, yet expected output growth remains above 3% in 2022. Surveys suggest that these forecasts carry a high level of uncertainty, with risks to growth tilted to the downside in the near term. And this is shown on the right-hand chart. On the one hand, surveys point to significant concern among businesses about future activity, so this is the yellow line, reflecting the exceptional uncertainty about how the war will affect the global economy over the medium term. On the other hand, they suggest that the immediate impact of the war on economic activity, the blue line, is moderate, also as the easing of contact restrictions is providing an offsetting boost to sentiment and activity. From today's perspective, therefore, it is uncertain whether and to which extent the drag on private demand will weigh on medium-term inflation. In fact, we are observing that investors are demanding a rising compensation for the risk of medium-term inflation turning out higher than expected. Moreover, as shown on this slide, long-term inflation expectations of professional forecasters are becoming increasingly more reactive to inflation today, as indicated by the increase of the blue line. And this was in fact a matter of deep concern in 2015, when low inflation dragged expectations down, ultimately leading to the launch of our asset purchase program. By showing resolve, monetary policy can break this dynamic and reduce the trade-off that central banks face between stabilizing output and inflation. A central bank that is perceived as being committed to protecting its mandate can contain inflation at a lower economic cost, since the expectation that adequate policy action will be taken is itself stabilizing. And such credibility is vital for the conduct of monetary policy. Continuing the path of policy normalization is therefore the appropriate course of action, respecting the principles of optionality and data dependence. The speed of normalization will depend on the economic fallout from the war, the severity of the inflation shock, and its persistence. As monetary policy is focused on preserving price stability, the headwinds to growth can be buffered by fiscal policy. That said, unless the economic situation deteriorates markedly, current circumstances call for targeted support rather than broad-based fiscal stimulus for two main reasons. First, monetary policy remains highly accommodative. The left-hand side of my final slide illustrates this. It shows the real interest rate that investors expect to prevail in 3 years' time. That is, when the adverse effects from the pandemic and the war are likely to have faded away. This rate remains in deep negative territory, meaning that there is a long way to go before monetary policy becomes restrictive for growth and employment. Second, Euro area governments face a trade-off themselves, namely between business cycle stabilization and debt sustainability. The right-hand chart shows that debt has increased materially as a result of the pandemic, and fiscal deficits remain sizable. Governments need to face the current shock, mindful of the fact that high debt levels leave the euro area vulnerable to sudden and costly shifts in investor sentiment. All this means that fiscal policy should follow a two-pronged strategy. First, governments should prioritize spending on investments that will raise productivity and potential output, thereby reducing the burden of high legacy debt. Implementing faithfully the structural reforms linked to the Recovery and Resilience Facility will be an important part of this endeavor. Second, governments should provide temporary and well-targeted support to protect those seeking refuge from the war and those who are most vulnerable to the sharp increase in energy prices and the sanctions. Preliminary estimates suggest that the measures already taken by several member states could compensate for a non-negligible part of the estimated impact of the war on aggregate demand. Coordinated action at European level could complement national initiatives, emphasizing our determination to shoulder the costs associated with protecting our fundamental values in unity, solidarity, and I probably should add enlightened self-interest. All in all, and with this, I would like to conclude, an appropriate monetary fiscal policy mix will be decisive for fostering social cohesion, protecting people's purchasing power, and sustaining the recovery in the current very difficult circumstances. Thank you very much.